Can you hear me? Hey, Mark, can you hear me right now? All right, let's see how this is going to work. Okay. Hey, everybody. Hope you guys are all having a good day out there today. Sorry, my dog's having a little bit of a fit, so he's having a little bit of a fun trying to hop on my desk, even though he's a massive German Shepherd. But anyway, big news coming out for today is a few things here. Um, right now, see if I can show this to you very fast. There we go. Right now, the big news here is that the CPI came down even more, and we saw inflation come down actually lower than expectations. So we were hoping for a 3.3% increase, and we actually got a 3.2. Not a massive not a massive beat, but still, it's good. Anything that's better than expectations is definitely going to send the market higher here. What I wanted to show you guys is what's happened since then. The market has continued to break out on some of these larger trends, which has been very nice. Now we're, of course, hitting some levels of resistance. Right now, it's order blocks or levels of resistance, but basically, the market wants to reach another batch of all-time highs, even though the economy itself is continuing to slow. Over the past few weeks, if you guys look at some of the oscillators on the bottom of the screen here, I can actually hide this for a second. You've seen that we've actually started to turn bullish, and over here, the momentum has started to shift. Now, as far as I'm concerned here, when I look at stuff like the MACD or the stochastic, I'm thinking that it's kind of weird how we've had a pretty poor earnings season, yet we are seeing a lot of assets go higher and higher. Bitcoin's been going more volatile. Dow Jones has been breaking out over the past few weeks. NASDAQ just broke out a few weeks ago as well. Let me add this trend line on here just so you guys can see. And ever since we managed to have these breakdowns, or excuse me, breakouts, there has been more of a thought in my head that possibly we're in a kind of this weird bubble scenario. Because if you guys look at the NASDAQ, there's not really a justification with how earnings have been going for the NASDAQ being this close to all-time highs, especially with all the crazy stuff we're going to be experiencing next year with the slowdown. And this brings us back to the overarching theme of what we've been talking about over the past few months. People are placing their bets on what Jerome Powell is going to have to do next year. There's two scenarios here, really. You could even say that there's three scenarios, perhaps. The first scenario is that we go into a recession sometime, throughout 2024, and basically Jerome Powell has to lower rates. This would give the stock market a big boom. It could possibly help out the economy, especially if we are reaching our 2% target. But a recession plus a 2% target inflation beat, we actually hit that 2% goal of the Fed. That would lead stocks to have a massive rally, even if a lot of Americans are really struggling because of their own financial situations. The stock market, the crypto market should be going up very, very high at that point. Now, the second scenario here is that we have a recession or we have a very large slowdown in the economy, and then people are asking for a rate cut, but we don't hit that 2% inflation. Let's say we just get to 2.5 or just at 3 by sometime next year. What'll happen then is the market will have a massive drop, somewhat similar to the size we saw last year. And let me just go over here to the NASDAQ so you guys can see. This was not a big old crash. This was all 2022 around here. Oh, no, where am I looking at it? This is very fast. Gotta zoom out. I forgot I'm on the daily chart, not the weekly chart. We would have some type of multi-month dump similar to what we saw last year. This is, again, if we have somewhat of a recession or a very large slowdown in the economy, followed by not meeting inflation expectations, and then the Fed having to keep rates higher for longer, like they said they're going to do. Then they've been saying that adamantly until we hit that 2%. And only then, once we have inflation tamed, will they consider keeping rates lower. All right. That's probably the most likely scenario, I think, at this point, because inflation has been falling, but it's not like inflation has been it's not like inflation's at 2.5% or 2.2% right now. It's very much so still in the threes, which is not a great thing, but at least it's trending overall in the right direction. And in the other scenario, this one's kind of I think the big thesis out right now, according to all the Wall Street experts, is that we meet our 2% inflation, and then we don't have a slowdown in the economy. The economy still kind of trickles down for the most part, still going strong. And then we also have a reason to cut rates, and then that would keep things going up higher and higher and higher. For me, that one doesn't seem as likely. I still think that we're going to be heading for more of a recession, but you can definitely see why a lot of people have been getting very, very bullish. You see some of these oscillators over here over the past few weeks, bullish signs over here, a breakout, you buy the breakout, and it's been confirmed so far. Now, when we actually go into some of this data here, you'll see that some of these things like the core inflation rate definitely continuing to come down over and over again. Core CPI price index still going up a little bit here, but overall, you can see we've had a pretty big drop so far in the summer. And that's actually what you kind of want to see here. It's not drastic. I know that they make this chart look very drastic, but this is just 127 to 118. Pretty similar spots. Historically, I should probably go to the last 25 years. There you go. We've been in a pretty crazy uptrend. Now, people are not really having the most or the best time with their finances at this point. You've seen credit card debt continue to go up, and maybe I can actually find that for you guys right here very fast. First, let's go over to food inflation. That continues to go down. I know a lot of people have been concerned about food like eggs, bread, things like that. It's been coming back down quite fast. Now, this thing that sucks here is we did have this inflation, and inflation is actually still going up, but year over year inflation, which a lot of this is actually coming down. But you are still seeing food prices continue to rise, just at a much slower pace than the culture shock or the shock that we got last year, right? So overall, what does this mean for the markets? Because if you guys looking at Bitcoin, NASDAQ, SPY, or just anything out there, like it could be a Google or an Nvidia, it's really going to depend on what happens with inflation going forward, especially with the next few meetings that we get. Because if we have anything more of a tick back up, so to speak, that's where things are going to get a little bit more difficult. I don't know if I can find the normal CPI number here. It's been this website, Trading Economics, got an update. Let me go over here and check it out. CPI Trading Economics. Inflation rate. There we go. It was a little bit easier than I thought. Now, back over here in July, we ticked back up for the first time. All the way back from last year, it was 7.1, 6.5. Overall, you can see we're going down. We never ticked back up and showed any level of stickiness here. And so from August to July, we actually managed to go from 3 to 3.2. And remember what the markets did at that point. Zoom out a little bit. July, the market stopped going up and everything started to reverse. So this is the same with the NASDAQ, SPY, come back down, Dow Jones. All of them found relative highs, and then they had to consolidate for a while until we started to see, the economy slow down enough where people thought inflation would thereby also be coming down. That's why you saw a whole bunch of bad earnings, things like that. That's why you saw Google, for example. Let's go over there. That's why you saw Google have a terrible earnings report, and yet it's still managing to bounce. Those bad fundamentals are still there, but the market doesn't care right now because all they're thinking about, is, oh, this is a big dip. If we have rate cuts next year, Google's going to be way above 140. It might be up here to 160, 180 by that time. And that's the big thing here. Everybody's trying to assume what the Fed is going to do. And if they get it right, they make a bunch of money. It's one of those very large gambles. But if it does not go well, then you're going to see some really massive crashes on a whole bunch of stocks that are usually not as volatile as you would think. A lot of the people on CNBC and Fox Business, if you guys remember, their original problem with Bitcoin was, funny enough, it was super volatile. So it dropped down 10% in a week, 20% in a week. But now you're seeing that happen a lot with stocks, which is actually crazy. And so you can see over here in this period of time, you saw that Bitcoin dropped during the rate hiking session or season, Google dropped 45%. Stocks usually aren't supposed to do that unless there's some type of severe circumstances. You guys can see over here during COVID, it dropped down only 34% during COVID. Normally, we see these smaller moves like this, right? 25% over a period of months. That's okay, right? We got a financial crisis over here. You'll see that we actually came down pretty heavily, 66%. So that's usually a crisis moment. Inflation was bad, but I don't think it was necessarily a massive crisis. It was just people getting used to the interest rates. Now, a lot of these things haven't made new highs just yet. Some things like NVIDIA have because of the revolution in AI, so to speak. But don't be surprised if we come back next year and inflation's a little bit stickier than we thought. That's where you're going to see a lot of things like Google and even NVIDIA come down to make some really crazy, not new lows, I would say. Maybe we don't break down below some of the lows we had last year, but coming pretty darn close to it. And just take a look at all these charts. Microsoft did the same thing. Microsoft's at all-time highs because of their acquisition of ChatGPT and the OpenAI basically. But all of these things can easily have multi-month crashing events, which is why usually I would remind you guys just to take a peek at how far something fell down last year, because as soon as the market turns back over on us, those support levels are going to be very crucial. So let me just hit auto here very fast. Look at Meta, right? Avgo, not as bad. Netflix, really bad. We even talked about buying the support last time. ConocoPhillips, oil's been doing very well. So far, it's been coming back down quite a bit. CVS coming back down quite a bit here. So everything is going to be watched closely as far as your positions, because if inflation for 1 minute ticks back up, the party pretty much stops here all of a sudden. The party stops, and then you have to start worrying, uh-oh, how far are we going to go this time? Sometimes it's not bad. Like you see right here, Netflix peaked over here in July, came back down a few months, not terrible. Some things like Meta kept on going sideways because of some moves with AI, having actually decent earnings. And then you have other stuff you might say like Warner Brothers, which is having a rough time of it. And even with okay earnings, but high debt, they're not really having a good opportunity here because all of that high debt comes with more expensive, higher interest rates because, again, everybody's still mulling over what is the Fed going to do month to month when it comes to those FOMC meetings. Now, Target coming back down. You're seeing that weakness there. You're seeing some poor earnings. But when it comes to tech, for whatever reason, I really do sincerely believe we're in a massive bubble, and that bubble will pop sometime next year. And that's going to be your opportunity to buy some really long-term positions. Normally, when we're looking at different companies and different stocks, I like to recommend people looking at the moving averages on the monthly or the weekly charts, preferably on the weekly charts. But you can see over here, we've been having some death crosses of late on Target. And Target last year had that really big move here as far as inflation rates going higher, people panicking, people warning about inflation and how everything was going to get more expensive. Target may be a little bit special in itself because they did get sucked into the culture wars, but you'll still see that last year they came down 50%. And so far they went down as much as 62%, now kind of bouncing back up to 52% down. Now, those death crosses are important because it means eventually we're most likely going to have a death cross here between the 20 and the 200. And that's going to be sometime late 2024, which is, I guess, when people are trying to say that recession might be there. We normally don't have moves like this, which is making this so interesting because of all the stimulus that got put into the economy in 2020. A lot of these stocks are going to be looking at some historic drops, which will basically just be a massive market reset and a great opportunity for you. Now, I know nobody wants to see inflation go back up, but that inflation going back up is going to give you guys a lot of opportunities. But I would say on both sides, because at least you know if inflation does start to tick back up, that's when you guys are going to see opportunities to short or more realistically get puts. Now, cryptocurrencies and things like that are a little bit more different in these types of scenarios. This is a basic Bitcoin chart here. Maybe what I'll do for you guys is actually open up a 6 Bitcoin chart layout, and we'll just go to the normal one here for now. Let's go to the monthly chart. Actually, in fact, let's go to the Coinbase monthly chart because it gives us more historical context. Right here, July is where Bitcoin also found a peak, even when inflation actually ticked back up. And you saw it come back down a little bit, but overall, there was no real concern to freak out. What you saw a lot of was those same support levels that were resistance back over here before the FTX crash. Those support levels managed to hold, and now we're looking at higher blocks and things like that. I can even actually add some of these tools on here for you. And perhaps I can even show you some of these larger moves that are expected. Everything is still fairly bullish. Everything is still looking pretty darn good. Again, but if we do have that tip in that pump in inflation, or increase in inflation unexpectedly, that's where things again are going to get more concerning. I would say right now, because of how inflation is doing, it doesn't seem like it's going to happen sometime next month or the month after. We may actually have another couple months of good, profitable moves. You've even seen oil, which is a huge proponent of oil and energy inflation. You've seen that going down quite a bit over the last few months. It peaked up here in 2022 around $125 a gallon. Now it's all the way down at 75, 76. More importantly, if I go back to my other trading chart, I actually have oil technicals that are much easier to show you guys here. COVID always messes up the charts here. Let's go to the daily chart. Let's hit auto, and there you go. We broke out a while ago, and I was telling you guys this is a good opportunity to buy some oil stocks. If you guys took that opportunity, awesome. August, going up here to September, really saw a lot of strength. Over here in July, oil was actually going more sideways, and then we still had an uptick in inflation, which was the concern. Even with all this, inflation really didn't get too bad. That really means that people are really slowing down enough where the economy as a whole is slowing down, not enough to go into a recession because we did have those blockbuster numbers as far as GDP, but still causing a little bit of concern. The only way you guys are going to be really upset with oil now is if we have a full-on reversal for whatever reason, and that would bring oil maybe back up here to $86 or so. The only scenario in which that happens now, because the global economy is slowing as a whole, is if the Israel conflict were to expand dramatically into a more of a regional war. After the Hamas attacks on Israel, they've been going back and forth with a few rockets coming from other places. It doesn't seem like Lebanon's going to go full on invasion. It doesn't seem like Yemen's going to be launching a whole bunch of rockets where it causes the U.S. to really go in with ground forces, or the Israelis. Excuse me. That's going to be fine. The one thing here that's slowly escaping my mind is to think about it, but it is important, is earlier this week, President Biden had a joint event, or I think it was a summit of some type, with Xi Jinping. And during that summit, he let it slip that there's probably going to be a ceasefire between Israel and Gaza. That should give a pump up to the markets temporarily. I don't think it's a long-term pause. I think it's like a few-day pause where some hostages get released and some aid gets put into Gaza, or some aid probably gets given to Hamas or something like that. But that could be a short-term move for the markets to go a little bit higher, especially because what you guys are seeing right now on a lot of these different charts is because of the good CPI news and a lot of the good AI news, I guess you would say. Things like the NASDAQ that have had these massive gaps. Even SPY's had some pretty nice gaps. We're not even close to hitting some of these 20-day moving averages, which are usually a little bit more volatility for the market. usually when we come into contact with them, see those really big candles that come out of nowhere. Those big, huge candles are often really good day trading opportunities, but you start to see a lot more volatility. We're looking at a golden cross right now. Last golden cross definitely led to some really good things here between the 20 and the 50. They don't happen all too often. Not every single one is great, but usually when we're at highs, having another golden cross means a little bit more of a pump before ultimately turning back down. And of course, we're nowhere really close to the 200 right now. The 200 is going to be a problem in 2024. That means if you are more pessimistic about the market, 2024, primarily in January and February, would be very bearish months, but still the overall trend, because of the way inflation's been going, has been pretty nice. So take your time. Don't rush into any trades right now. I really would not be buying close to all-time highs for a lot of different assets. Let me go back to the weekly chart so you guys can see what I'm talking about. We're close to the breakout here. I'm almost hoping this turns out to be one massive double top, but we'll have to see, because we are so close to making all-time highs again. And if we close around where we are this week, you guys are most likely going to have future pumps because of the inflation rate and what we've been seeing. The only real concern that I think a lot of people have, as far as people that aren't really heard from too much on the mainstream news organizations, but maybe they're heard a little bit on Bloomberg and, Yahoo News, more often Bloomberg, I would say, because they have more studious folks there. Over the last few decades, whenever we have inflation, it's rarely ever a peak and then we go back to normal. What you guys will normally see is a peak, crashes back down, and then we have another huge jolt back up. This happened back in the 70s and 80s, happened back over here in the 40s, happened over here, looks like in the early 40s, or some late 40s, or maybe the early 50s. We normally have multiple peaks of inflation. That's really the concern here, because that leads to multi-year issues. At this point in time, we are looking at kind of a historic thing that kind of caused all this inflation. COVID pandemic worldwide, and then a whole bunch of carnage as far as lots of money being poured into the economy when the government didn't have a way to really pay for it. And you're seeing America's debt primarily spiral out of control to just historic levels where it makes no sense that we have this much debt. And, of course, a government shutdown looming every few months at this point. So don't be surprised if the government tries to pass another massive bill, that a lot more money being infused into the economy might cause that uptick. Now, again, not causing a massive peak just yet. That would take time, but uptick. That's why you want to see us getting back down below 3% as fast as possible, which is still likely in this scenario, just because, we're at 3.2%. A little nudge will do the trick. But I want you guys just to be aware that because inflation is the spotlight of the market, like I said before, earnings don't seem to matter right now. Go look at Google again. Earnings crash does not matter. People ignored it completely, and we started to pump back up. Sometimes it may matter, depending on what type of sector you're in. Things like Walmart seem to be a little bit less exempt from pain. Less exempt from pain than things like Google. But if I go over here to, I don't think I have it on my watch list, but I know the ticker by heart. You'll see things like Walmart hitting that order block. The way the market's going, this would be a strong buying opportunity, and you're just waiting for that reversal to happen. And then you latch on, and then you're trying to play the bounce back up, which is kind of sad, to be honest, because this means that we're most likely going to be in one massive bubble that will pop eventually. But it's so hard to time the fall, the fall of a bubble, or the popping of a bubble, so to speak, that you kind of have to just play along with the market that's being given, which means, when you have a breakout like this, you start to buy from multi-week holds or multi-day holds, whatever you want to call it. Whenever you see breakouts, you still have to play them like normal. Change your character. You can buy right there, or you can buy on a dip that comes back down, whatever. Sometimes people like to do it like this. Oh, let's go right here for this change of character. Change your character buy. You can wait for it to come back down into a golden zone, then you can buy back up, or you can go right here at support. But my focus here is this. The market's in a big sense of denial because everybody's focusing on inflation and not the actual fundamentals of the market. You've seen that rates have been coming down quite a bit over the past few weeks because of it. Since October, yeah, the past few weeks, yeah, about a month now. Rates continue to come down. 5 years coming back down as well. Death crosses, last death cross was around a nasty move here. Death cross usually resonating around bad moves here, or downward moves. So as this continues to come down more and more and more, you guys are going to have opportunities to go long on a lot of positions. At this point, if you want to see bonds go higher, you might just wait for a support level to be hit somewhere around 4.3%, a little bit less than where we are now. And then from there, you'll see a temporary pop on rates, especially if the news kind of helps it out. And then you'll see those buying opportunities for a lot of different asset classes. It could be stuff like Dogecoin, for all we know, which is up a little bit today. Things like Ethereum, which are down a little bit today, or things like the traditional stock market. And I think you guys will be fine with that. But don't trade right now without having at least a little bit of an understanding of what's going on in the bond markets and then what news events are happening, because every time we have economic data, that really seems to lead the way with the overall market, especially if it's going in the market's direction. So right now, everything in the market is bullish. We've had the breakout, everything is looking a-okay. So if we have good news come out from CNBC or anybody as far as economic data, that's where you guys are going to be looking at some nice stuff. And look at this. Amazon cuts several hundred jobs in the Alexa division. Now, that's not a huge one, but still, people are still losing their jobs here. And it's happening among more sectors than just the big, companies like Amazon. You're still dealing with the fallout from the union strikes. And they finally ratified the deal. They actually said no to the first deal. I don't think people actually realized that because they didn't want to make it into a big thing. But the workers actually said no. They voted no for the first time. So there's a lot of stuff happening. U.S. crude fell. Oil fell into bear market this week and could head lower as China haunts the market. Right? A lot of stuff that you guys should just be aware of. And you guys can't necessarily just trade off of the technicals because that's the easy way of trading. And it doesn't look like we're there yet. Whether you guys are trading NVIDIA, Meta, Avgo, whatever it is, even things like oil, like my beloved PXD that I've been talking about forever now. The technicals don't matter right now, even though it's temporary breakout, but we broke down here. The technicals aren't mattering as much because of what's happening with all the other things that are just more important to people. Again, you can be thinking about oil prices traditionally for an oil stock, but reality is like geopolitics, what's going on in the world, things that happen in Israel, and then the fact that inflation's going down at this point, that type of stuff. So make sure just kind of keep an eye on your charts because there's a lot of stuff that's not making sense right now. And it's unfortunate, but that's just the way it's going to work right now. Even take a look at Tesla here. Tesla broke down, came back down a little bit, coming back up, pretty much just ignoring that longer trend that it has, but that's okay. And I wonder why this is actually here. This should be about, there you go. Tesla ignoring those moves, but at least on some of the more shorter time frames, you've seen it actually honor them slightly. Breakdown, earnings coming down, earnings really finished it off, so it wasn't so much of the technical event. But you guys get my point. Just wait for Tesla to break out, and it'll probably have a massive move because it's Tesla. But don't be surprised if we have some type of strong economic data that makes people freaked out that thinks we may need another rate hike, in which case, even if we have a breakout, and this is not just for Tesla, even if we have a breakout, a lot of stuff will end up coming back down. And it kind of sucks because a lot of people a lot of people that trade like me were really heavy on technicals, but you can't just look at technicals. And that's the really scary thing about this market. So I hope you guys all have a wonderful day. Please make sure to learn more about rates and how they work, bonds. You guys could be watching Bloomberg or CNBC. TradeZing has a bunch of stuff right now posted by Bloomberg, and I'd actually recommend looking at those because the topics are really, really helpful, especially if you guys have no idea where to start. And you're seeing a whole bunch of mixed messages with the market. on a lot of different assets. And the ones that are the scariest at this point are the ones that have horrible earnings, like just bad earnings. However, the market is still pumping them up because they're hoping for strong rate cuts coming into next year. Okay. So have a good night, everybody, or a good day wherever you guys are. And thanks for stopping in.